Hi, lovelies. She came in on a Tuesday morning, folder under her arm, printout of her mortgage statement inside it. She'd been overpaying for 3 years, £200 a month every month, on top of her normal payment. She was proud of it, told me she was getting ahead, and she was mostly. What she didn't know was that she'd been doing it the way that costs the most. Not because she wasn't trying, because nobody had told her there was a right way and a wrong way. When I worked in a bank, I saw this constantly. Good intentions, wrong method, money going in, less of it working than it should have been. This video is about the difference between the two. And if you've ever put extra money toward your mortgage and felt good about it, some of what I am about to say is already costing you. What overpaying actually does. This is where most people think they already know. They don't. Not quite. Most of us have a rough idea, pay more, finish sooner, that is true. But the mechanism is more useful than that. And once you see it, the decisions that come later make a lot more sense. On a standard UK repayment mortgage, interest is calculated daily on your outstanding balance. So every extra pound you pay reduces the balance, and from the very next day, you are being charged interest on a smaller number that compounds forward every month for the rest of the term. I used to explain this at the counter and watch people sit up a little straighter. Not because it was complicated, because nobody had framed it that way before. I remember sitting with a woman once and running the numbers together on her printout. She was on a £200,000 mortgage at around 5.2%, with 25 years left on her term, adding £200 a month on top of her normal payment. The interest saving came to over £38,000, and it cut nearly 7 years off her term. 7 years from £200 a month. The mechanism works. The question is whether you are using it correctly, because there is a version of this that quietly works against you, and most people land on that version without realizing it. The penalty most people don't know exists. This is the one that catches people, and it caught the woman with the folder too. Many fixed-rate mortgages in the UK have what is called an overpayment allowance. It is a cap. A limit on how much extra you are allowed to pay each year before the lender charges you for it. The standard limit is 10% of your outstanding balance per year. On a £200,000 mortgage, that is £20,000. Go over it and your lender can charge you an early repayment fee on the excess. Most people have never heard of this. They assume they can just pay more whenever they want. They can, up to a point. Past that point, the lender takes a cut of the money you are trying to save. The allowance resets either on the 1st of January or on your mortgage anniversary date, depending on the lender. Most people don't know which one applies to them. She didn't. She'd crossed her limit in the second year by a few £100s. The charge was small, but the principal stung. She'd been penalised for paying off her own mortgage. One more thing worth knowing, because interest is calculated daily. A lump sum paid early in your allowance year saves more than the same amount paid late. A bonus that arrives in January and goes straight in is worth more than the same bonus sitting in your current account until November. Not by thousands, but not by nothing either. One simple way to check: find your original mortgage offer letter. The overpayment allowance is written in there. If you can't find it, log in to your lender's online account. Most show it clearly now. The rate comparison most people skip. This is where two people with the same mortgage can have completely different correct answers. Overpaying your mortgage gives you a guaranteed return equal to your mortgage interest rate. If your rate is 5.8%, every pound you overpay effectively earns you 5.8%, tax-free, risk-free. No investment comes with those conditions. So right now, for most people on current mortgage rates, overpaying is a strong move. Average 2-year fixed rates are sitting around 5.8%. The best easy access cash is A's, are paying around 4.5%. The maths currently favours the mortgage, but not for everyone. I remember a couple who came in together. She had remortgaged recently onto a new deal at 5.7%. He was still 3 years into a 5-year fix he'd taken in 2021. His rate was 1.8%. She was right to overpay. He wasn't. His guaranteed return from overpaying was 1.8%. He could have put that same money into a savings account and earned 2.5 times more. Same instinct. Completely different correct answer. The difference was one number they hadn't compared. Try this. Write down your mortgage interest rate. Then check what the best available savings rate is right now. If your mortgage rate is higher, the maths may favour overpaying. If it isn't, your money may be working harder somewhere else, and that is worth knowing before you commit it to the house. None of this means you've been doing something wrong. Most people overpay with good intentions and a rough idea that it is helping, and it usually is, partly. But there is a part of this I haven't got to yet. The part I watched quietly cost people the most. Not in penalties, not in rates, in what happened when they needed the money back. The money you can't get back. This one is the quiet one, and it is the one most people never think about until it is too late. When you overpay your mortgage, that money goes into the house. It reduces your balance. It is not accessible. If something goes wrong, if the boiler breaks, if you lose income, if there is an emergency and you need that £3,000 back, you cannot just phone the lender and ask for it. You would need to apply for further borrowing with affordability checks at whatever rate is available at the time. Your money is in the building, not in your account. I saw this play out badly for a man who had overpaid aggressively for 2 years. He was made redundant. He had almost no savings. All the extra money had gone into the mortgage. He came in to ask whether he could access it. We had to explain that he couldn't. Not quickly, not easily. Overpaying while carrying high-interest debt, or before building an emergency fund, is the financial equivalent of decorating the outside of the house before the roof is fixed. It looks like progress. It isn't. Most mortgage advisors and personal finance guides suggest having 3 to 6 months of expenses accessible before making significant overpayments. The man who came in that day wasn't reckless. He was trying to do the right thing. The problem was that doing the right thing with one part of his money had left him with nothing to reach for when another part of his life went wrong. 2 people, 2 outcomes. I want to show you something rather than just tell you it. 2 people I dealt with over a number of years. Same bank. Similar mortgage balance, similar income, same starting point. The first one overpaid everything she could, every bonus, every spare £100 at the end of the month, straight onto the mortgage. For 5 years she did this. The second one did something different. He set up a standing order for a regular overpayment, just inside his 10% limit, and he put the rest, everything else that was spare, into a savings account he kept completely separate. A different bank, a different login, treated like it wasn't there, around £150 a month. Consistent. Every month, 5 years later, she had a meaningfully lower mortgage balance. He had a lower mortgage balance too, slightly less reduced than hers, but he also had around £9,000 sitting outside the house. Money he could reach, money that hadn't disappeared into the building. She wasn't wrong. He just asked one question she didn't. What happens to this money if I need it? That question changed what he did with the overflow. Not the regular overpayment. That stayed. Just the overflow. The difference between them wasn't discipline. It was one decision made once and repeated quietly for 5 years. The 2 numbers that change everything. Most people making this decision are missing the same 2 things. Not the willpower, not the money, the information. Everything in this video comes down to 2 numbers. Most people making overpayment decisions right now don't know either of them. Number 1, your exact mortgage interest rate. Not the rough one, the exact one on your statement. That number tells you the guaranteed return you get from every pound you overpay. Number 2, your overpayment allowance and when it resets. That number tells you how much you can pay without triggering a penalty. And when the clock starts again, both numbers are on your mortgage documentation. Both take about 10 minutes to find. Neither one requires a financial advisor. She didn't have either of them when she came in that Tuesday. She'd been overpaying confidently for 3 years without them. When we sat down and looked at both together, she saw exactly what she'd been doing, what it had cost her, and what she could change. She left with both numbers written on the back of her statement. That was the whole thing. 2 numbers. The people who overpay well aren't the ones who pay the most. They're the ones who know what they're paying into. None of what I've described is permanent. Every pattern here can be interrupted, but the decision is yours to make. And the only way to make it properly is to know your 2 numbers. What is my mortgage interest rate? Exactly. What is my overpayment allowance? And when does it reset? Once you know them, you'll know whether you are overpaying the right way, or whether, like the woman with the folder, you've been doing it on good intentions alone. Good intentions are a start. The numbers are what make them work. Slow down, think clearly, and that is how you start to love your money.